Welcome back, students, and we are now in week 2 of our accounting course. If you have fallen behind, understand that I do accept late work. I simply mark it down 10% per week that it is late, so please don't give up on that. Turn it in. I see that most of you have submitted your work. Same with the quiz. If you had an interruption or weren't able to complete the quiz, let me know. I may adjust that for you by reopening the quiz to take a second time, although I'm not very free with that. That has to be earned. In Lesson 2, we cover Chapters 3 and 4 of the textbook. Recall that this is an accelerated course, so you're going to do a bit of work. Chapter 3 introduces the double entry accounting system, which we talked about our first day of class. In order to accurately capture the vast number of financial transactions that a business engages in each year, the system was introduced over 500 years ago. This is what we call the double entry system. It is somewhat like the traffic laws that keep cars and people flowing in Los Angeles, or maybe not. Red means stop, green means go. In our analogy, debits and credits are what we'll be recording. We begin with the accounts. An account is an individual record of increases and decreases in a specific asset, liability, or stockholder equity item. We saw a list of accounts used in the balance sheet report on page 2, or in chapter 2 on page 75. Note that there are 3 classes of accounts: assets, liabilities, and equities. For teaching purposes, we will display these as T accounts, so called because they resemble the letter T. In actual practice, these accounts are managed by computers and no longer take physical form until it is time to report the account balances. The terms debit and credit refer to the left side and right side, respectively, of each T account. The fundamental accounting equation guides us when recording increases and decreases in an account using debits and credits. For all asset accounts, a debit represents an increase, while a credit shows a decrease in that account. Both liabilities and equities are exactly opposite, with credit entries showing increases and debits showing decreases in these records. Asset transactions are categorized as to source, exchange, and use transactions. The text gives several examples of each. Note that every transaction involves 2 or more accounts. One account is debited, the other is credited. We call this system double entry bookkeeping. Note also that each transaction is presented in horizontal format that emphasizes the accounting equation. This is to help you understand the effects of each type of transaction on the financial reports. The process of generating data to be entered into the accounts begins with source documents. These include sales receipts, invoices, checks, time cards, deposit tickets, and so forth. Every transaction must begin with and be backed up by a source document. These are stored until they can be legally shredded, generally after a period of 2 or more years, or as dictated by the IRS. Each transaction is recorded in a journal, which is called the Book of Original Entry. This allows the accountant to track every transaction chronologically. The increases and decreases for each of these transactions are then transferred to the separate accounts. The collection of all accounts is referred to as the ledger of accounts and therefore called the Book of Final Entry. The process of transferring data as debits and credits from the journals to the ledger accounts is called posting. When this is done, a systematic cross-reference is also recorded so that each account entry can be traced to a journal record of the transaction, which can be supported by a source document. This allows auditors to check the accuracy and reliability of the financial reports based on the accounting records of a business, presuming they are complete. The trial balance is a tool for checking the accuracy of the accounting record. It is based on the fact that total debits and credits recorded in a ledger of accounts should equal or balance. Hence the term we get balancing the books. At the end of each accounting period, at least once a year, the accountant closes the temporary accounts by transferring their balances to permanent accounts using closing entries. The final balances are recorded in the financial reports. A trial balance is performed, and the cycle begins anew. Finally, the authors introduce the subject of financial analysis by showing how the accounting records and reports can be used to judge the financial health of a business. This is an entire course in itself, but we'll examine the fundamentals in class. Chapter 4 shows accounting for a merchandising business. These are commonly called either retail or wholesale businesses. A key feature of this type of business involves accounting for inventory. Take note of the learning objectives for the chapter found on page 188. We start with a discussion of the perpetual inventory system. Later, we will introduce alternatives. Our goal is to accurately measure the cost of goods being sold. The difference between the revenue from sales of inventory and the cost of goods sold is called gross margin or gross profit. We then subtract selling and administrative costs from this figure to find taxable income. After paying taxable income, we are left with what we call net profits. The goal of every business is to make this final number as large as possible. Economists call this activity profit maximization. The balance of the chapter details of transactions affecting inventories and sales and their effects on the income statements and balance sheet reports. I would suggest that at this point, if you are not attending class, you work through the examples in chapters 3 and 4. This is what we will spend our time on in class on Monday night when we meet. Look forward to seeing you all then. Goodbye.